Okay, so with the recent COVID-19 pandemic, we've seen some tumultuous markets in the last couple of weeks, and actually the last couple of months on top of that. Uh, we're also dealing with fears over, the illness that's associated with it, our health for our families and ourselves, the potential job losses as a result of the crisis, and, just plain frustration and not being able to live our normal lives the way that we're used to. So first and foremost, we want to let you know that we're here for you through all this. And if you want to talk about anything that's concerning you or stresses you out, even if it's not necessarily about money, we're here for you to do that. And second, we also want to encourage you. So we've individually and as a country, we've faced crises before. In the past, we've come out better and stronger after them. And amazing innovations take place during difficult times. So we're seeing the same thing happen right now. And we really think that there's a lot to be hopeful for in the future. Those who embrace these challenges, like the one that we're facing head on right now, and reinvent or reimagine themselves, the ones who are willing to innovate will not only go through this, but will thrive through it. So there's something that we like to call thrivalist, and we think that everyone has the ability to be a thrivalist. So someone who can see the silver lining even in the darkest of times and find the opportunity to make something better. So using that mindset, we really think that we can make it through this and thrive together. Today, we're just going to be talking about how we can help you thrive, not just in the current market, but in any type of volatile market or crisis. It's our hope that you'll come out of this webinar feeling like you really understand how the market behaves and you know what to expect from it so you can prepare for a lot of different types of scenarios. And when we build your portfolios, we prepare for a lot of scenarios on your behalf, but we also want to be sure that you're right there alongside of us every step of the way, building the portfolios and looking at lots of different scenarios to make sure that you're not just planning for the best of times, but also the worst of times and in between. So we're going to explain how market volatility works, and we're going to spend some time talking about how we as humans and our brains tend to react to volatile markets. So this is based on research from behavioral scientists that have studied our brain and which parts of it are activated when money's involved. We'll talk about how we plan for volatility and how we partner with you to help your plan stay on track to the best of our ability, no matter what the markets are doing. So let's get started here. First, we want to talk about why volatility exists and how it acts. If you're walking along and this bear jumped out upon your path, what do you think you would do? Most of us would want to run. I certainly would. But contrary to our natural instincts, wilderness guides tell us to lay down on the ground and play dead. There's no way to outrun, outswim, or outclimb a bear. So your best bet is to face it down by lying on the ground. The same is true of bear markets. By running away, you might only make the situation worse. By facing it down, you'll be well prepared to make it through. Quick disclaimer, I by no means am advising you to go out and face down bears, or do I advise you how to deal with a bear. In general, I would say they're best avoided. So just quick disclaimer there.
Did you see that there was a video of a woman that did confront a bear and she slapped him on the nose and he went running away? That was not what she should have done.
Yeah, that's a very direct approach. I don't know what the experts would think about that. So something that we want to acknowledge up front here is that investing can be stressful. While the saying goes that money can't buy you everything, we know that it's not about what you can buy, it's what the money represents to you. While it might represent something different for every one of us, I think that we can all agree that no matter who we are, money represents our future and how much flexibility we have and our choices in the future to live the lives that we want. So with all of that tied up in our money, it's a wonder that any of us are willing to put our money into an investment account. So why do we do it? We all know that stuffing it under our mattress or into a hole in our backyard means it'll lose worth over time from inflation. That's just the nature of the world that we live in. And now with very few pensions left and longer lifespans, we have to fund our own lives for what could be many years to come. The only true way to do that these days is by putting it into the stock market. So that's why we're all here today. We invest our money to protect against inflation so our money doesn't lose value, and to potentially grow the funds to help us fund our future retirement or future goal. We also know the market isn't just going to keep going up all the time. Unfortunately, I wish it were, but actually sell-offs are needed in order for us to make money. So let's talk more about that. You've likely heard the term before, but what is volatility really? Simply put, it's changing stock prices. Sometimes they can change wildly from day to day or even in a single day. For example, if one company's stock starts off the day at $5 a share and ends the day at $10, or the other way around, you could start the day at 10 and end up at $5 a share. When you're investing in multiple stocks, which is kind of like what mutual funds or exchange traded funds, ETFs, allow you to do, this can be a little unnerving when you see your fund losing value throughout a day or a week. However, this is one way that you and other investors make money, so it is kind of necessary. For example, let's say you buy a stock at $1 a share. Over the next month, it could go up to $10 a share. But then the next month, it plummets back down to 50 cents a share. You're getting nervous, right? I would be. But if you're continually investing, you buy more shares at that 50 cents instead of your original price. Then over the course of several months, the stock goes to $5 a share. And then, hey, you've made money. Great. So even though the price went up and down wildly, in the end, you came out ahead. So this example reflects an investment technique called dollar cost averaging. And that means you're purchasing a fixed dollar amount of a particular investment on a somewhat regular schedule, regardless of how much it costs. So as a result of that, you're ending up purchasing more shares when prices are low and fewer shares when prices are high. It just averages out to be a lower average cost for you. So when implementing this strategy, it's important that we consider your ability to keep purchasing through fluctuating price levels. So even though you're not adding money into an account continually, there are dividends and capital gains that are being reinvested for you sometimes. So this has somewhat of the same effect. So with all things, keep in mind this strategy doesn't ensure that you're going to make a profit and doesn't protect against loss in declining markets, but definitely it helps your odds. When volatility is happening, it makes all of us nervous. And really the big thing is to remember that it's common and that it happened all throughout history. So it's not just something that's particular to 2020, even though we've had a lot going on. It's happened, every year you look and you see drops in the market. Every decade you see big events, big crises. And while it's unpredictable, we want to be able to take advantage of price swings if we can. But, doing that, trying to price the market is really almost impossible to do. Simply put, volatility happens because investors try to hedge their bets. They want the best deal and they want to make as much money as possible. So if it looks like stock prices might decrease, investors sell and try to make a profit at the top of the market. If things are looking good and the future appears bright, investors buy and they think their investment will only go up in value. Investors in the markets they invest in prefer to be stable. They like stability. Stability means that things are likely to continue as they have been. So not a lot of change there. When there's instability, investors get nervous and they sell because they think that things likely aren't going to get better. So they try to get the most money they can by selling today. As soon as investors anticipate that they're going to get better, they buy. So it's kind of that back and forth. It's if you think there's stability, you're likely to buy. If you think there's instability, you're likely to sell because you're not sure of what's going to happen. So let's talk a little bit more about what causes volatility to help you understand it. There are several items up on the screen, but really anything can cause volatility. Some things make sense. For example, if you're looking at individual companies that their financial performance, maybe it's not the greatest. That's going to impact the stock price, as you would think. If a company doesn't make as much money as they expected, their stock price will probably go down. That type of price change makes sense. But a lot of times, stock prices will change, simply because how the investors are feeling about it, how the investors are feeling about the overall market at a certain point. If they're nervous about life in the future, they may start selling a lot of shares of that stock or a lot of stocks and making the prices go down. If they're feeling good about life, they might start buying a lot, vice versa. Anything and everything can impact how investors feel about life. Politics, the news, two big examples, which a lot are intertwined lately. But the main thing to think about here is that people are not predictable. And the market is based on people and full of people. So the stock market essentially is not predictable either. So what do we do then with that volatility? First, we need to look at how volatility has occurred over history. So if you can understand how the markets have acted in the past, it can help put that volatility somewhat in perspective for us. The markets have gotten very volatile with major upswings and downswings in the past. But all in all, in the end, they historically have been trending upward. Secondly, it's important to remember that volatility is common in long-term investing. So when volatility happens, we have to remember that it's to be expected, it's common, and it could also be an opportunity for you. Thirdly, we have to have a plan for your investments, which we help you with, and also how are you going to handle volatility when it happens to you. So you have to kind of prepare yourself to see the volatility in the markets and remind yourself what your own plan is. So you're coming up with your plan ahead of time, and then you have to stick to it and really be, strong with yourself and say, this is the plan, this is what I have to stick to. And then fourth, we have a diversified strategy that can help you weather volatility in lots of different kinds of markets. So we'll talk a little bit more about that in a minute. Before we go on to looking at the markets a little bit more, does anybody have any questions about kind of the basics of volatility?
I don't. I just have something to share, just real quick.
Sure.
I have an app on my phone, and it shows it's the stock market, and my grandson is 4. He looks at it every day. If it's green, he counts the green. I don't know if you can see it. Does anyone else have that app? Well, you guys don't need it because I don't know if you can.
Yeah, we have lots of charts and bars and stuff all over our screens every day. But yeah, some of those things are kind of neat to look at to give you an idea of what's happening.
Yeah.
There's a lot of different indexes that are out there that, depending on what area of the markets you're looking at, some might be US based, some are more international, some are certain segments of the market. It's really looking at those things and then trying to piece it all together really gives you a good perspective instead of just looking at one index all the time. So some people might follow the Dow Jones or the S&P 500, but really taking a look at stocks and bonds, because likely your portfolio has both of them in there, gives you a better idea of maybe what a diversified portfolio should be doing. Does that make sense?
Yes.
Okay.
And Mary, does that mean that your grandson is heading into our line of work in the future?
It's very funny. He's fascinated by it because when it's red, he'll count the red and he'll count the green. And I just kind of gave him in a nutshell, what a 4-year-old can understand. But
That's
he's kind
great.
of fascinated with it. He'll open it up and he'll look at it and count. And if it's all green, he'll say, "This is good."
Awesome.
Now,
Great. All right. Is it okay if I go forward with just a little bit of background on the markets for everybody?
Sure.
yeah.
Okay. All right. So this chart shows how markets have performed historically. Over 20 years or so, despite always having volatility, over the long term, they've trended upward. There have been times when the market is trending down. Without those times, there wouldn't really be opportunities to purchase, stocks on that are cheap, considered cheap, or low priced, and potentially make money in the future. When stock prices are low, investors in the past may have seen opportunity and purchased those stocks, which drove the price up, resulting in the market kind of trending upward. Over time, prices can get too high and investors sell, which kind of starts the cycle all over again. That's kind of a little bit what we've been seeing recently. While this cycle could change in the future, it makes sense that it would continue though, because there's likely always someone who sees an opportunity to invest in a business and purchase stock that's low cost, depending on their perspective. And when purchases happen, it makes the market go up. Now, it's important to remember that everything we looked at is showing how the market's performed in the past. We can't know or guarantee what's going to happen in the future, but we can learn from that history and use it to apply it to our strategies today. And throughout history, the market has faced sometimes some extreme crashes and dips, but it's always recovered. So this is kind of a neat chart that shows you quite a few periods in history. And if you look, you can actually see a few different times that multiple crises have happened in the same decade. Some of them might have, a varying degree of change in the market and varying degrees that it took to recover in the market. There's actually things in here from all the way from the 60s up through the 2000s. So if anybody wants to see more of this, we can always send you a copy of it. But it's always interesting to kind of keep that in perspective and see, some of the worst ones. If you look at the Lehman bankruptcy, how long that took to come back. So that's pretty interesting. Really, like we said, what happened in the past doesn't mean that it's going to happen again and that it's going to act similarly. But it helps us. It can give us a good indicator going forward. And because we're human, when things look bad, we want to get out. But remember that we said in the beginning, the best way to deal with a bear, including a bear market, is to stay the course. So by fleeing the market when things start to get scary, you could potentially miss out on the best days of the market as well. So missing just 5 of the best days over the past 20 years would have reduced your investment returns by 2/3 on this S&P 500 index. And that's a pretty common experience when you look at market history. So you can see that if you were fully invested, you would have returns around 7.7 if you went from 1990 to 2019. If you missed the single best day of the year, you would cut that return just about in half. And then it keeps going more and more depending on how many of the best days that you miss. What's interesting is that markets tend to have the best and worst days close together also. So by selling out of the market and avoiding those worst days, you could also miss out on the best days. This is why timing the market is really quite difficult. You just can't be sure when markets are going to turn around. So just when you think things are going to get worse, that's usually when they can turn around and start trending upwards. But yes, there are forecasters out there who attempt to figure this out when the market's at the bottom and at the top. Very few have gotten it right consistently, and absolutely none have always gotten it right. So that's a pretty staggering statistic there. No one always has the right answers. Who would have thought? Think about recent market volatility. We had some truly horrible days in the market so far in 2020. The days when many of us thought things just couldn't get worse, but when we had a couple of major upswings, the news actually wasn't looking the greatest. Investors saw the opportunity there. That's why some of those up days happened. It wasn't predictable though. We wouldn't have been surprised if the market continued to decline. And just like this chart, the worst day happened very close to the most recent best day. So now that you've seen how these markets react, how the best days and worst days are often pretty close together, it makes the market really hard to predict. And you can see how going against what everyone else is doing could potentially be the better strategy. So we all know the old adage is to buy low, sell high, but as a group, most investors do just the opposite. They buy when stocks are on the way up and they sell when they're on the way down. In general, throughout history, investors get nervous and they sell out, often right before the market take off. So when the crowd is fleeing the markets by going against the flow and staying invested, you can potentially do much better in the long run. All right, so before we learned a little bit about what volatility was, and now we understand a little bit more about the markets and how they tend to react. So now, how do we respond to volatility? So like we talked about earlier, to weather volatility, you need to understand that volatility happened in the past and that it's pretty common. And you need to have a plan for your investments and how you're going to handle that volatility. And make sure that part of your plan to handle the volatility includes a diversified strategy. So don't let volatility motivate you to make a bad decision. This can lead you, it can put you at risk for locking in those losses when you sold out. And it can leave you with less opportunity to participate in the market rebounds. Like we said, those best days usually come very close to the worst days. Investors who get nervous and pull out of the market when prices are dropping usually end up losing money for all the reasons we just talked about. So up on the screen is proof of this. The S&P 500 is one of the stock market indexes. It's pretty much a gauge for U.S. large companies. And, it does have a mix of growth and value in there, depending on when you look at it. But it's a group of stocks, and at its most basic level, when we look at it, you can see how the markets are doing. It's just kind of one of those things like the Dow Jones that people just tend to watch. So over time, it's trended up. And you'll see that the 30-year average annualized return is close to 10%. It's 9.96. A lot of investors invest in the group of S&P 500 stocks. Maybe it's through a mutual fund or an ETF. However, their returns don't match the index's returns. The reason behind that is because they often get nervous and they pull their money out of the market. So the end result is that they lose out on returns that the index would have had because the index doesn't sell out. So for example, the 30-year average return for that investor is only just over 5%. So that's about a 5% difference with the normal or with the average investor investing in the same exact thing, except that group of average investors, they pull out their money at the worst times.
So when one pulls their money out, what do they do with it?
The majority of people tend to, if they're moving money out of the stocks, out of the stock market, they tend to go with something more conservative in their mind. So maybe they move money towards bonds or maybe cash. Really, I think the idea for most is to just get more conservative, whatever that means to them.
And an important note for that last slide that you had up, Adam, that was specifically the S&P 500 against an equity investor. So it didn't take into account the drawdown that the fixed income side of their portfolio might have on their return. It was just stocks to stocks.
Yep, very true.
Yeah. So if they got out, that's what they lost out in potential return.
Does that make sense to everybody? Does that raise any more questions for anyone? Okay. All right. So, basically the moral of the story is to make a plan and try to stick to your plan to stay invested so you can weather that volatility. The plan that we create with you is really based on your specific timeline It's designed to account for market fluctuations to the best of our ability. And if you commit to stick to that plan and continue to stay invested, you'll be well positioned to work towards those goals that we help you define and work towards. Nothing is certain, but sticking to that plan over trying to time the market is really the most appropriate approach for most investors. All right, so here's the interesting piece out of this. We're doing a little bit of biology. So we got our history lesson. Now we're moving into some science so we can see how we actually react when money's involved. All right, so most of us probably think that because money is related to math, it involves the logical part of our brains. But scientists actually found that the opposite is actually true. Money activates the emotional part of our brains, the amygdala, or sometimes people call it the lizard brain. The lizard brain is one that simply reacts and responds to external stimulus without pausing to consider the facts. This happens to all of us. We can't help it. It's simply the way that our brains work. And the lizard brain activates the fight or flight response, and it happens immediately. So if it sees a threat, it aims to mitigate it. It aims to, stop you, either fight or you flight. So that means if we are losing money, our fight or flight response is automatically activated. Driven by emotion, we have that need to do absolutely anything to prevent that loss. So even if we are removed from the situation, 100 feet back looking in, we would probably make a different decision. But it's our money. We have that emotional response. So we feel that extreme drive to have that fight or flight response.
I don't see a recording button on here, Adam. I don't think they're recording.
It is, like, I have it on my screen, Dolores. I'm not sure.
What's that?
I do see it on my screen that it's recording because I have the option of pausing it or stopping it.
Oh, I can't see a recording button on my screen.
Okay.
Adam, are you seeing it on yours?
I'm looking at a limited version right now, just because I have the screen share on. But
I think we're good.
Yeah, we should be all right.
All right.
It was on earlier. But oh no, I see it. It's in the top left.
Okay,
Yeah,
great.
Thank you for keeping an eye out, Dolores. We appreciate that. We have to record them for compliance purposes.
Oh yeah, yep, for sure. All right, so what do our emotions drive us to do when it comes to investing? So for most of us, we see dollar signs we want to buy. We feel a rush of excitement and possibility. If you see a big sale sticker, that sort of thing. But if we see loss happening of our own money, we want to sell. We feel a rush of fear and fear of losing our future because, money doesn't just have that monetary value. Like we said earlier, it's about our future goals, our flexibility, our retirement, a lot of different things wrapped up there. And, just as we discussed, both of those things, it's completely opposite of what we all know in our heads what we should do. So our lizard brain does not help us make wise investment decisions. Something that's really exciting is that you can actually train your brain. That's pretty neat. You can actually force it to go against how it's normally wired. So thinking about creating a new habit. After you consciously choose to do something over and over for several days, eventually it becomes automatic. So when you do this, you're actually creating new pathways inside your brain and you're changing the way your brain works. So to do this, you want to activate the logical part of your brain, which is called your prefrontal cortex. By using that part of your brain, you can actually train yourself to remove emotion from the equation. Pretty neat. So how does this happen? You use this part of your brain to plan ahead of time how you're going to react. So you're kind of walking yourself through a scenario that hasn't happened yet. So recognize how your brain wants you to react and decide you know what, I'm not going to be emotional, I'm not going to listen to it. You're going to go against your automatic reaction that you might normally have. So for example, if you know that your emotional brain is going to drive you to sell out of your investing plan, acknowledge it, and then decide ahead of time that you're not going to listen to that voice telling you to do that. It's hard to do, yes, and it's going against the ancient wiring of our brains that's gone up through evolution. But the way to do this is to have an accountability partner. So someone that's going to empower you and help you stick to this strategy. So you can choose, anybody to be your accountability partner. You can choose a spouse, a friend, family member, or us, your financial advisors. But whether or not you want us as your accountability partners, we're here for you anyway. We're here to help coach you through this, to help you through the difficult markets and help you stick to your strategy. There's actually a Vanguard study out there called Quantifying an Advisor's Alpha. That's that link that you see on the screen. And they've determined that an advisor has the potential to add 3% returns to an investor's portfolio by being an accountability partner and behavioral coach. So simply reminding clients of their long-term strategy and commitment to staying invested. So that's what we hope that we can help you to do. Stay on your target. And now that you know how markets react and how your brain wants you to react, in addition to that, let's talk about how we can help you plan ahead of time for that volatility and help train yourself to stay the course. So first, we have to remember that the strategy is based on you. So it's all custom made to you, your goals, your needs, whatever those might be. Your strategy is about your goals, your timeline, and your risk tolerance. So we aim to reach your goals. You know those for certain. What we don't aim to reach is a specific market return or performance. That's uncertain. We can't time the markets. We don't know what the markets are going to do. So it's really important to keep this in mind because others out there might simply invest to get the most money possible. But in our mind, that's not the best approach because reaching for the most may not be necessary, and it could introduce some unnecessary risk for you. You're taking on more risk than you might need to. So we try to reach for what you need with how comfortable you are with risk. And we also, talking about that risk tolerance, we manage for that risk tolerance. We want to keep you comfortable with the amount of that risk that you're taking on in your portfolio, because as we've seen, nothing is certain. So risk, reviewing what that means, it's risk is the chance that an investment's actual return will be different than expected and means that you have the potential to lose some of your investment. And we use a strategy that fits your view on that risk-return trade-off. So, it's really important to remember when you're looking at this sort of idea, how much do I need in return? How much do I want my account to grow? There's a lot of different things involved, but most importantly, it's your goals. You have to make sure that it's meeting your goals and that works for you, and that you're taking a level of risk that's comfortable for you as well. So there's that trade-off. If you take very little risk, you can probably expect lower returns. If you take a lot of risk, you could have some high returns, but that also comes with quite a bit of losses potentially. And we also diversify. So diversification simply means that you have different types of investments in your portfolio. Investments from different asset classes that they don't perform the same way during different market environments. Sometimes one might be up, one might be down. For example, stocks tend to do well when interest rates are low, whereas bonds tend to do well when interest rates are high. That's just one example. But there's many different types of investments and market environments also. So since no type of investment always does well, we combine those different types of investments and they can help compensate for each other. So when one's doing poorly, another may offset it by doing well. and vice versa. The result can be, a portfolio that has less drastic price changes. And, diversification can never completely get rid of volatility, but it can help manage it. So it's also important to understand how we plan for and anticipate market volatility. We already talked about your strategy, how it fits you, your goals, your risk tolerance, your timeline, and that it'll be designed to behave a certain way to align with these goals and what your needs are. And, like I said at the beginning of the presentation, when we started talking about stock indexes, we actually look at specific benchmarks when we try to take a look at your portfolio and how it's doing compared to the market and different kinds of investments. So it tracks specific benchmarks, not necessarily those market indexes that you watch in the news every day. And that helps track you towards your certain goals, because that benchmark is going to be aligned very similar to how you are, with a certain percentage of stocks, a certain amount of bonds. And it's just, for some people, those indexes that you see on the TV screen, they don't realistically match how you're invested. So while your portfolio will be designed to weather a variety of different environments in the market, you'll still experience dips and spikes. So ups and downs, it's just how big those dips and spikes are that will depend on how much risk you take. So if you take less risk, you're probably going to see less movement up and down as compared to someone that's more aggressive. I'll give you an example. So let's say that you're very conservative and mostly you're looking for income from your portfolio. We'll help you build a strategy that aims to trend up very slowly and have fewer dips and spikes, so a steady increase over time. You may not have large gains, but you should have fewer losses. On the other hand, let's say that you're very aggressive and you're looking for growth. We would help you build a strategy in that case that aims to have higher returns, but with that, you'll also see larger losses in the short term when the market's down. So it's a little bit of give and take there. And, we anticipate and plan for that volatility in your portfolio, but it's really always helpful to keep in mind what your portfolio is driving for, what the goal is, and what your time frame is for those funds in that account. So keep in mind that none of these strategies ensure that we're going to have success or protect against a loss, but it's managed to your comfort level. So that's not to say that we just leave your strategy on the shelf once we've constructed it with you. So we continually review that strategy and we'll make adjustments to it if it isn't doing what it's supposed to do. So that doesn't mean that we're making sure it's doing better than those markets like we talked about. We're making sure that it tracks with its own goals and the goals that you've set up and that we've gone over together. Ooh. There we go. Ooh. There we go. All right. So if you're, I did just do that. Where am I going here? Sorry, everybody. I clicked too many times. All right. So really, what we want to do is monitor the portfolios and make sure that they perform the way that we expect them to when markets are volatile. So we want you to understand what your strategy is trying to do and how it should act when we experience that volatility. But bottom line is, when you hit that volatility and you don't feel comfortable with how it's performing, it might be time to review your goals, come see us, talk to us on the phone, and see if we might need to adjust the way that we're managing the account for risk. It may mean that you aren't as aggressive as you thought. You can always reach out to us. So if you have any concerns, we can take another look at the goals and how you feel about risk given what's going on at that particular time. In the end, our goal is to have the strategy that you're comfortable with that helps you work towards what your individual goals are. And I know the past couple of months have been pretty challenging ones for all of us. And the future is definitely not certain at all, but we are all in this together. We're here to help you through whatever you need. It's really times like these where we feel that we can be of the most value to you. We're available if you want to discuss anything that you've seen in the markets, that you've read. If you have any questions at all, if there's anything that we talked about today, we're happy to take some questions after this. But really our job is to help you build that strategy that works for your goals. And, even when the outside world is kind of going crazy, we'll help you stick to it. So that was all that I had to share from my screen for you. This is just a little bit of disclosure material here. So I'll just stop the share. And I'll open it up to see if anybody has any thoughts or questions that we would be able to help you with.
Hey, Jean, I didn't see you sneak in.
Hi.
Were you able to see most of the presentation?
Yes, it was. I was just late getting on.
Perfect. All right. So like Adam said, does anybody have any questions? Anything that we can help with? Any concerns? No?
I think you're being available when I do have questions and concerns, and getting back to me, it's kind of a process that just keeps on happening. I mean, not that I ask that much, but when I have these crazy thoughts, I just email and you get back to me. And I can see where it's at a comfort level. The investment is at a comfort level for me.
Good.
Yeah.
And I think a lot of times it really is just making sure that you have somebody that you can talk to about it.
Yes. And that knows, that has that working knowledge. Absolutely.
Yep.
Because I just have, that's why I went on today, to just learn a little bit more. But, I didn't go to college for it and study it intensely. So it's, yeah.
Yeah. I thought that the lizard thing was pretty interesting, Adam.
Yeah, we full of animals in this presentation. Lizards, bears.
Yep. Yeah. But it is
a lizard to explain the amygdala.
Yes.
Yeah. But it's interesting. I mean, you think about, if you're trying to start going to the gym or getting into a running routine or anything like that, you kind of, the first few times you do it, you really have to force yourself to do it. And you kind of try to make it something repeatable to where, okay, it's 5 o'clock, I'm going to go do this. And then after a little while, it's just, if it hits 5 o'clock and you're not doing that thing, your brain's like, hey, what's going on? You're supposed to do this.
And then the gym closes. Yes.
Exactly.
Yeah. Then you take a bicycle.
Yep.
Yeah, Heidi, you got an electric bike. How's that going?
It's fun.
Yeah, it's one of those things.
Good for going up steep hills.
Yeah.
You don't want to hurt your knees.
Maybe we have to do one on that. Do a camera and follow you and Gary around, and
We'll set you up with a GoPro. You'll be fine.
there we go. I like it. We can have people following, they could be on their bikes doing the same thing.
We got to get Gary involved in that.
Yeah. Okay. All right. We'll think on that one.
Yeah, we'll do like a Tour de France sort of thing. We'll have a convoy and everything.
Tour to Plattsburgh.
Oh, that'd be funny.
Yeah. Dolores, any questions for you or anything that caught your eye or that you had a question on?
Nope, I'm fine.
You're good? You're good.
You just keep doing my work for me. I'm all
We will continue to do that. Absolutely.